Hey everybody, Kirk here with Tactical Options Trading. Thank you for joining us on this video today. So today we're going to be talking about option strike prices. If this is your very first time here and you're interested in learning more about options trading, click that subscribe button and the bell icon so that you do not miss out on any future videos. So let's go ahead and get started. So what are strike prices and how do we use them when we trade options? So a strike price is the exact price that you agree on to buy or sell the underlying stock or security. It's basically a contract. When we talk about contracts and buying houses or cars, we have an agreed upon price that we have made that contract for. So that's basically what a strike price is. It's an agreed upon price to buy or sell the underlying stock or security. So to illustrate this, let's take a look at it in terms of strike prices of the coupon. So we're all familiar with coupons. And when we talk about coupons, let's say we had a coupon for one of our favorite places to eat. In my case, it would be a barbecue restaurant. So let's say we had a coupon to go get a lunch combo for $2.99. Now I understand barbecue is not going to be $2.99. It's probably going to be a little bit more than that. But let's just say, for example, in this situation, we had a lunch combo coupon for $2.99. Well, we're all familiar with coupons and how they work. So let's say this coupon gives us the right to go in there and buy this lunch combo for $2.99 anytime before that expiration date of August 15th, 2018. So you can see right there, all the terms of the contract are laid out there in front of us. We can see that the expiration date is August 15th, 2018. And that strike price in this situation, we're going to call it a strike price, is $2.99. So when we talk about strike prices and options, we could look at it as in terms of striking a deal. So we're going to strike a deal for this lunch combo at $2.99. It's already out there. We can see what the price is. We know what we're paying for it. And now we're going to go out and use that and purchase that lunch combo. So let's think of this as a strike price in our lunch combo. So what does that look like in an options chain? So let's take a look here. We're looking at an options chain of Caterpillar. CAT is the symbol for Caterpillar. And you can see that, as in the case of most brokerages, we have the strike prices that are going right down the middle of the screen there. So you can see we have the strike price there of 133, 134, 135, 136, and so on. So all those are our strike prices, which means that we can use those strike prices. We can buy this option at any one of those strike prices before the 21st of September 2018. So that's basically what it looks like in an options chain. Now if we take a look at the chart here of Caterpillar, you can see that those strike prices are basically just represented by prices in the stock, either at the market, above the market, or below the market. So let's talk about the differences of buying an option versus selling an option. So when we use those strike prices, we can either be a seller of that option, or we can be a buyer of that option. So when you buy options, that gives you the right to buy or sell that stock at an agreed upon price. Just back to our coupon example there. That coupon was $2.99. So we had the right to go in there and buy that lunch combo for $2.99. So when you buy an option, it gives you that right to purchase that underlying stock at that agreed upon price that you have set in the contract. So now let's talk about the selling side. So when you sell an option, you have the obligation versus the right. You have the obligation to buy or sell the stock at an agreed upon price. So let's say we go back to our example of the coupon here. Let's say it was barbecue joint that offered this coupon to us. When they offered that coupon to us at $2.99, they're obligated to honor that coupon of $2.99. So back here looking at our lunch combo coupon, this gives us the right to go in there and purchase this combo anytime before August 15th, 2018 for that $2.99. But if I was the barbecue company that issued this coupon, I'm obligated to honor that coupon. So if somebody came in and wanted to use this coupon or exercise that coupon, we would be obligated to sell this lunch combo to them at $2.99. All right, back here to our cat example. So when we're the seller of options, we have that obligation to buy or sell the stock at an agreed upon price. So when we buy a call, for example, we have the right but not the obligation to buy the stock at an agreed upon price. When we buy a put option, we have the right but not the obligation to sell the stock at an agreed upon price. So let's go back to our example here of the options chain. And I want to show you, and you probably saw that earlier, that on the left here we have the call side, and on the right we have the put side. So if we buy a call, that gives us the right to buy stock at a certain price. Now if we buy a put, that gives us the right to sell stock at a certain agreed upon price. So let's go to this little chart that I have made up here, and we'll kind of go through some examples here. So you can see that we're looking at buying calls and buying puts. So when we buy a call, that gives us the right to buy stock. And I want to go ahead and pull up a blank screen here, and we'll talk about when we would want to buy a call, and when we would want to buy a put, and when we'd want to sell a call, and when we'd want to sell a put. So let's say that we saw this stock and it was moving up, and we thought, wow, you know what? I think I want to go ahead and buy an option on this. So let's just say we wanted to buy a call option. So when we buy a call option, we have a bullish bias on the market and we want that stock to go up. So let's say the stock is currently trading right now at $100. So we went ahead and bought the 100 call. Just to make it simple, we're going to say we bought the 100 strike price because we thought that stock would continue up. So let's say it did continue up and it moved on up, and now that stock is trading at $105. Now you can remember we bought the 100 strike price, the 100 call. So what does that do for us when we bought that 100 call? So what that does for us is it gives us the right to buy stock. What price does it give us the right to buy it at? It gives us the right to buy it at the agreed upon strike price. And what price was that? It was that 100 strike. So now the stock is trading up here at $105. We have the right to buy this stock that's now trading at $105. We have the right to buy it at $100. And so we paid for that right. That was like our coupon. We had that agreed upon price of $100 to go in here and buy this option. So now that stock's trading at 105. We have the option, if we want to go ahead and exercise that option and buy this $105 stock for $100. So that's where our coupon example comes into effect. So we have that right to buy that lunch combo for $2.99. Maybe that lunch combo is normally sold for $6, but we have the right to buy it at $2.99. So in this case, the stock is now trading at $105. We have the right, not the obligation, but we have the right to buy that stock at $100. Now let's go back and take a look at what it's like if we buy a put. So what is a put? So the put, when we buy a put, it gives us the right to sell stock. So when we buy a put, we expect the market to go down. We have a we have a bearish sentiment on the market. So let's take a look at it here on another example. So let's say we thought that stock was going to trade down, and we're coming in around that 100 strike again, but now we have a bearish sentiment on the market. So let's say we were right and we bought that put, and that stock continued to trade down. Now let's say that stock is now trading at $95. So when we bought a put, it gave us the right to do what? It gave us the right to sell stock. So now we have a stock that's trading at $95, but we bought the right, we bought that strike, we bought the $100 strike, which gives us the right to sell stock. So now we can sell that stock that is now trading for $95. We have the right to sell that stock for $100. So this stock is now trading at 95, but we have the right to sell that stock at 100. We don't have the obligation to, we have the right to. So that's what, when we buy a put, it gives us the right to sell stock. Now let's go back to our chart again, and we'll talk about the opposite side. So I understand that some of these concepts may take a little while for you to understand. When you're talking about buying calls and selling calls, most people understand that pretty readily. But when you're starting to talk about buying puts and selling puts, that's where it gets a little confusing, because it's almost the exact opposite of the call side. So let's say we're going to sell a call. When we sell a call, we have a bearish sentiment on the market. So let's say we wanted to go ahead and sell a call. So what does it mean when we sell a call? Well, now when we sell a call, we are obligated. We are obligated to sell stock. Up here, when we buy a stock, we buy a call, we have the right. We're not obligated. But when we sell a call, we are obligated to sell that stock. So let's talk about that. Let's talk about what it means when we sell a call. Let's go in here and take a look at it on a blank chart and on a blank screen, and I'll show you what we're talking about here. So let's say the stock was trading down and we had a bearish sentiment on the market. So let's say we're trading now around that $100 strike, and we thought that this stock would continue on down. So we went ahead and we sold a call at that 100 strike. Now you think about it, when somebody sells a call, there's somebody on the opposite side of that trade. There's somebody who bought that call. And when you buy a call, you have a bullish sentiment on the market. You think the market's going to go up. So when you sell a call, you have a bearish sentiment on the market. So let's say that we sold that 100 call. So let's say we were wrong on our assumption of the market going down, and that stock turned around and went against us. Well, if you remember, we sold that 100 call, and let's say the stock now is trading at 105. So if we sold that 100 call, what does that mean for us? Well, we're obligated at this point to sell stock at that $100 strike. So somebody who bought that call has now that this stock is now trading at 105, the person who bought that call has the right to exercise that stock and exercise that option and buy this stock for $100. So we're obligated to sell it to him. So now the stock is trading at 105, but we sold that $100 strike. So we're obligated to sell that stock to the person who bought it. So the person who bought it was the winner in this case, because the stock's now trading at 105, and they were able to buy this stock for $100, and we're obligated to sell it to them for $100. So now back to our chart. Let's take a look at what happens when we sell a put. When we sell a put option. So what happens when we sell a put? When we sell a put, we're obligated to buy stock. And like I said before, you might have to look at this a few times and go over this in your head a few times. But when you sell a put, you're obligated to buy stock. So let's go ahead and take a look at it again on a blank screen. So when we sold that put, we have a bullish bias on the market. So let's say we thought the market was going to continue in its upward trend here. And we went ahead and we sold the 100 strike. But let's say that we were wrong and that stock turned around and went against us, and now that stock is now trading around the 95 mark. So when we sold that put option, what does that do? It gives us the obligation to buy stock. So when we sold that put, somebody bought a put. And when they bought a put, that means that they're bearish on the market. So when we sold that $100 strike, we're obligated to buy stock at 100. So let's say, for example, that the person who bought the put at the $100 strike Now the stock is trading at $95. They want to go ahead and exercise that put. So the stock that's now trading at 95, we have the right, we have the obligation to buy that stock at $100. So the stock's trading at 95, but we have the obligation to buy that stock at $100. So the person who bought that put from us made money because that stock is now trading at 95, but we had to buy it from them at $100. So when we sell stock, or we sell options, when we're the seller of the option, we're obligated to fill that part of the contract. So I hope that helps. If you have any questions, let me know. It was fun making this video, and go ahead and take a screenshot of that. I'll take my face off of here and you can get a screenshot of that and you can use it for future reference. But I hope that this video was helpful to you and you enjoyed this video. If you have any questions or comments or feedback, that would be awesome. Go ahead and leave that in the comment section below, and we'll catch you next time.